Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm 𝗤𝘃𝗀𝘀. With me, as always, is Mark Ainley. Mark, Happy New Year. This is our first recording of January. How's your January off to us? How's it started for you?
It's good. I was worried you weren't going to come in strong enough because you haven't done this in a few weeks, but that was a pretty good come on in. So nice job there.
Thank you.
We have
all day practicing it, so hopefully it went well.
Yeah, listen, I'll give you a quick chuckle. I wanted to do the come in on one of these episodes. I actually was practicing the other day just like myself, and I didn't think my son was around, and he's like, "What are you doing?"
I told my one buddy, I was like, it's one of the funnest things to say. Like, just pause this recording or pause this episode right now and just say the word welcome, like as loud as you can. And it's like the best word to say. It just rolls right off.
Nice. So new year, new things happening. Well, first, what I want to do is I want to ask anyone out there that is listening, please either stop right now or finish to the end, but leave us a review. We usually don't ask that to the end, but I want to put it out there right now to make sure it's front and center. That helps us with so many other different rankings, helps other people find us. And it also makes us feel like someone's listening. So we definitely appreciate those 5-star positive reviews and leave comments. And we always like to see funny, entertaining comments. Secondly, Tom, you're either one or the other. You're technically an entrepreneur now, 100%, or you're unemployed. I'm not sure which one. Just want to say congratulations, man. Thank you.
Yeah, I am sans W-2 right now. So I am, and then kind of just taking some time in February to really kick things off. But I have, a couple different things going. I'm fully licensed. So I've been helping a few people. We actually have a couple of buys under contract in January, which is great. Doing that, obviously have the flips. And then I'm also teaming up with Jeff Weinberg over at Drexel Properties. So looking to buy larger buildings on the north side. So that's my life from here on out. I am left the W-2 behind, and it feels pretty damn good.
On your way out, did you like throw up the middle finger via Zoom and just like leave the room? Is
there's no really cool story of throwing a tantrum. I guess I'll make one up and talk about it on the next episode.
Well,
there's no movie. There's no cool movie like thing that happened.
Well, you are in a position, or what you did in the last couple of weeks is what a lot of people listening would want to do. Like, you did it and it happened, and you probably had the last couple of weeks to reflect. Like, any feedback for anyone, like in as far as how it feels, like that day one? Or
it feels awesome. It feels so good. It's in its pure honeymoon state right now, right? Like, and the other thing too is like, I probably could have done this move a year ago, maybe even longer ago, right? Like I'm at a point where it's not that risky. So I don't have like that deer in headlights right now kind of feeling that maybe you would have if you jumped it earlier, which might have been the right thing to do. I probably waited a little longer than I should.
Well, I will ask you in about a year if you should have done it sooner.
Yeah, when we're in a year from now, we're recording like, hey, Tom got a new W-2 job. Good job, Tom. So yeah, I'm excited. Let's flip it over to you. What do we got for the housing provider tip of the week?
Well, we're dealing with all these frigid cold. I'm listening to the wind batter against the side of my house right now. As far as prevention, what we had to do the last week or so is really just getting out ahead. One, with vacant properties, we make sure that we're visiting all the vacant properties. A dead thermostat battery or maybe a power tripping or something like that can cause sump pump to back up or the heat to go off. Like, just be proactive when we get these frigid, you get about 2 or 3 of these weeks every year. And that's where all the problems come from. That's where all of the properties you buy in the summer that have mold everywhere at a discount price come from. But be proactive, even with occupied properties. We have occupied properties. And think about this. The housing stock we have here in Chicago in the city, 120, 140 years old, some of it. And that insulation, if you ever gone down to do the brick, there's not much there. Not like your suburban properties that have, I came from 2x6s when I lived in my last house, like with insulation packed. So you get out ahead of it. Make sure you're opening up your cabinets underneath your sink. Make sure you're having for your older houses. Maybe we have our tenants run the water at a slow drip, just to kind of keep water moving through. And we got through this past week and a half fairly. We only had 2 broken pipes out of 1,200. So we call that a success. So
yeah, take that all day long.
Yep.
That's great. Yeah. One more note on the sub pump. It's useless without electricity, right? So like, if you don't have a backup generator, you did all that work, it's useless, and you're still going to have issues. And a lot of times when there's a storm like that, like power is going to go out. So be prepared for that.
Yes.
Like otherwise, it's just a waste of money. So, all right. Today's guest, we have, I believe, our first English-born guest. So this guy is intelligent from the start.
He's already smart. We already know that. So he's going to sound smart at least. We already know that.
Yeah. So born and raised in London. He spent the last 18 years calling Chicago home, though. So I would call him a Chicagoan at this point. He did extensive work as a derivatives trader. And then from there, he moved and placed his entire focus and commitment to real estate. Began investing in multifamily properties in 2009, and then became a full-time broker in 2014. He's been a top 1% agent in Chicago, the highest producer at his company for the last 5 years. He also has started the podcast Enter the Lionheart, which we'll link to. It focuses more on, it's not just real estate. It's more self-development, health, finance, a lot of good feelings and good vibes there. So he's a very interesting man. We appreciate Jake Fugman for the introduction. So without further ado, Lawrence Dunning, welcome to the show. Lawrence, I probably sold you short, but is there anything else you want to add there?
Hey guys, thanks for having me. That was a glowing introduction, and now I just feel like it could be a bit of a letdown. So you covered it. You covered it beautifully. So thank you so much, and thanks for having me. And yeah, kudos to Jake for the introduction.
Yeah, absolutely. So Lawrence, there's a lot to unpack. Let's start with, you spend a lot of time educating your clients on just the general benefits of real estate investing, right? You came from the trading world and you completely went all in on real estate. So let's talk a little about that, because before we started recording, we were talking about inflation, purchasing power, and why real estate. So exactly. Let's start there and take the conversation as it goes.
Perfect. Thanks so much, Tom. So the big thing I want to start with is the problem that we're facing today. So if we just start talking about real estate, obviously you've done a lot of episodes, but I just want to take a couple of steps back and just talk about the problem that everyone's facing today, recording this beginning of January 2020. So in the last 18, 19
2022, months, don't give us that.
Sorry, 2022. So in the last 20 months, because of COVID, we've added all the money supply in the US right now. 40% of it was added in less than 2 years. So we're finally starting to see this in inflation. But inflation's been happening, if you look at, a century ago, the $20 bill in your pocket could buy a bar of gold. Now that bar of gold is about $1,800. So there's been a steady erosion of the purchasing power of the dollar, but we've really seen it pick up in the last 50 years when Nixon came off the gold standard, and then even more so in the last 2 years. So this is something that it's likely it's been happening a long time, and it's probably going to continue for the foreseeable future. So it's hard enough. We all know it's hard enough to make money, and now we have this problem that once you've made it, it takes a certain amount of expertise to keep the purchasing power. So that's the big thing that we're all facing, that a lot of people don't realize is, yes, we're all trying to make money, but once you made the money, it's a whole nother skill to keep it.
Got it. So that makes sense. Why real estate though?
Perfect.
Right? Like,
yes.
Why? Let's dive into why this,
exactly,
as opposed to let's put this in the S&P.
Exactly. So that was perfectly what I want to talk about next. So I come from a finance background, and when I did my MBA in England, we talked a lot about stocks and bonds. That was pretty much it. It was stocks, bonds, and cash. They never talk about real estate. But if you look at all the asset classes, by far the biggest is residential real estate, and then number two is probably the debt market. Then you have equities, and then you have commercial real estate, and gold is tiny, it's insignificant, and then you have cryptocurrency, which is even more insignificant. But if you look at the news, you think cryptocurrency was the biggest market capitalization because it gets so much press. So the reason most people, MBA programs thinks they don't teach real estate is because real estate is just too different. It's too different within a city, let alone within a country, let alone between countries. So one thing I love about your podcast is you're a Chicago-based real estate investment podcast. So by the end of this, we're going to be talking specifically. But we start off generally, we got this problem with once we make the money, we have to keep the purchasing power of our money. Then we look at what we can do with it. Well, this low interest rate environment we're in, bonds don't even keep up with inflation. So you can get rid of bonds. Equities do very well with inflation, but we've had pretty much a 12-year run in stocks. So to buy now, a lot of the upside, you've kind of missed the boat a little bit. And so real estate, you're getting in, it's not a bad time to get in, but there's so many things that are specific to real estate that are very important. So I'd say the first thing is the cash flow. So I don't know when you're doing pro formas, I always look for 6 to 10% cash flow on an investment property. Now that's good, but there's so many other benefits that people don't realize with real estate. So I would say the first one, if you're working, is the tax benefits or the tax write-offs. It's a lot of people that are in high tax brackets. It'll be worthwhile them keeping a building that's breaking even just for the tax write-offs. But then on top of that, every time you're making your mortgage payment, you're actually paying down principal too. So I'm a spender. I love to make money, but I love to spend money too. I like to enjoy myself. So if I spend every penny of what I made, I'm still ahead, because between all my investment properties, I'm paying down, I don't know what the actual exact amount, but maybe 8,000, 10,000 a month just in principal I'm paying down. So that's another benefit, is the loan aspect is an easy way for people that are busy and they like to enjoy themselves. It forces you to spend money without even thinking about it, getting a paycheck and investing it. So you have that automated thing built into the loan. So that's something I really like.
So one comment there, hold on, sorry to interrupt, but like one comment for people who are newer, like the biggest miss I feel is, let's say you have $100,000 to invest. And let's say like the stock market and real estate are doing the same. They're both going to go up at 8% or whatever. Like, let's just call that apples to apples for a second. You can purchase $100,000 worth of stock. In real estate, you can go buy a $500,000 asset. And if that's appreciating at 8%, you were getting the full advantage of that $500,000 appreciation, compared to even if the stock market would have to literally like triple perform that real estate asset to come away with these same gains. And then you don't have the tax benefit as well. So like, exactly. not trying to turn this into like a brainwashing episode, but like, it's such a missed point, and it's not like my opinion. Like that's exactly. Stats. That's numbers.
Well, as a proud immigrant to your wonderful country of America, if you look at the first multimillionaire in American history, he was actually a real estate guy from Germany, John Astor, and he was known as the landlord of Manhattan. So the uber wealthy have known about these tricks of real estate for a long time, and it's people like you guys that are with this podcast trying to bring this message to the masses. So what you said is perfect. I'm going to add one thing to it though. So basically, if you have like your example, a $500,000 property, you put 100,000 down, you have 5-to-1 leverage. So if it goes up 5%, you've actually made 25% on your initial investment, because you got the multiplication. But it's even more so in this environment where we're seeing inflation. What you want to have huge levels of debt, because every year with the erosion of the purchasing power of the dollar, that debt you owe is actually worth less in real terms. So it's such a great hedge, because there's very few things that you have the upside of real estate and the leverage and the tax benefits and all that, but you don't have the volatility. So a lot of people are making crazy money. I'm going to use crypto as an example, because crypto is a hot topic. They're making a lot of money in crypto, but the volatility, you can see a 50% downswing. And one thing I remember when COVID hit in early 2020, I'm getting my years confused. Sorry, March 2020. I remember when it hit, I was like, okay, this is going to be a good, let's see my real estate model. Let's see how it goes. Let's see if a $800,000 multi-unit, there's going to be a fire sale and it's going to be selling for $550. And we really didn't see that. I don't know how closely you guys were following the multi-unit market in Chicago, but I was fascinated to see there was, maybe an $800,000 building was selling for $775. It was very close. It wasn't the crazy crash that you might expect from such a huge event like COVID.
Yeah,
no, go ahead, Mark.
I think a lot of anything that came out after COVID was people. From a Chicago perspective, I thought there's more people fleeing the city that have. I thought like places like the Gold Coast, where that owned free and clear for 25 years, and like, listen, I'm out of here. I'm not dealing with this stuff going down on Michigan Avenue, and I own it free and clear. If it's 50 grand less, like that's where I think I saw some of the more significant. And then you had a bunch of the South Loop and Loop with kind of the surplus and condos. I think that's where I saw the greatest kind of hits after COVID, and it still wasn't that bad. And any of those call it hits, but they're really man-made hits that they did. People chose not to wait, chose to exit faster. Those have all rebounded and actually probably even gone up a little higher than where they were prior. So
exactly, and that's another thing. Talking about the how specific real estate is. So not just within a city, you'll literally have east of western, west of western, these huge big dividers with big differences in cap rates in the city. But what you said is perfect, Mark. You talk about the type of real estate. So you're right. downtown, you had all these people saying, screw this, all the riots and the crime and things being closed. I'm going to leave the city, and the suburb market was very strong. But talking about pure investment properties, I mean, I had a pretty decent year in 2020. You know, it would have been better without COVID, undoubtedly. But things were still selling not too far off pre-COVID. And then now, of course, we're coming to the other side of it, where there's a lot of smart money. I've actually missed a few properties for some of my clients, where you have these funds that are buying these buildings cash, you know, out-of-state funds. And they're looking, well, we've got all this money now in the system. Where's it going to go? And we kind of started off talking about how where they can put their money to work. And a lot of people are looking to the Midwest. The Midwest has always had historically pretty strong cap rates. So you've got East Coast, West Coast, out of the country investors. And it's crazy. I mean, some of these funds, they're buying these multi-million-dollar properties cash. So there's a lot of people with very deep pockets that are looking to invest their money, and they're looking at Midwest multi-units.
Yeah.
So Lawrence, let's talk a little about where do you, so, all right, you're in Chicago here, but our listeners probably don't know much about you. So talk to us about what is your typical business model? What are the areas you play in? What is the type of asset that you bring to market? And then I'd love to dive in a little further.
For sure, Tom. So it's not that I have areas where I say, okay, I want to work in these areas. It's where are the best returns and the best opportunities? And that kind of steers me to a few of these pockets within the city. So if you're looking at a map of Chicago, you have, downtown, let's say Navy Pier is kind of like, ground zero for Chicago, downtown prime lakefront condition. And then you're going to spread north, west, and south. And you're going to go out from the center, because multi-units that, downtown are just, they're few and far between. They're way too expensive. You're not going to make any money. So somewhere like Lincoln Park is a wonderful place to live, but I wouldn't say it's the best investment place to invest, because the inventory tends to be much older. The taxes are very high. And I don't think the rents justify the purchase price. So then you're naturally spreading out. So Pilsen has been a very hot spot for Chicago. It was in Forbes magazine as one of the top 10 neighborhoods in the US. So it's been getting this press. A lot of developers have been there the last 5 years. So I've done a lot of business in and around Pilsen. So Pilsen geographically is a real sweet spot, because it's relatively close to the city, but it's just south of 290, which is the expressway splitting the north and south of Chicago. So you do tend to get a tax break when you're south of 290. And then you have these natural inbuilt tenant bases. So for instance, in Pilsen, you're between a university to the east and then Rush Medical District to the west. Rush Medical District, I read, you guys might correct me if I'm wrong, but I read it's the largest medical district in the US. It's between 40 and 50,000 employees. So right there, you have these huge inbuilt tenant bases. They want to live locally. So it's very easy to get strong paying tenants in and around Pilsen. So Pilsen, it's been one of the hubs that I've worked in, and a lot of developers that I work with tend to do things there, because it's the sweet spot between all. So when you look into my building, you're not just looking at return. You're looking at all these other factors. You're looking at rental demand, you're looking at absolute return, you're looking at rental upside, you're looking at price appreciation upside, you're looking at negative things like, how bad's the crime and things like that. So on balance, you have these pockets in the city that tend to have most favorable metrics. So Pilsen's definitely one. One thing I've noticed the last 18 months. So if you'd asked me 18 months ago, I probably would have said Bronzeville down to Woodlawn. So that's the south. People don't know Chicago. That's lakefront, but it's the south side of the city. So traditionally, the north side was the more affluent, and the south side was much less developed. And now we're seeing all these developers that are doing all these projects from Bronzeville all the way south to University of Chicago, which is Woodlawn. That for me is like kind of the new area to watch in Chicago. And I think that's probably got, from what I'm seeing anyway, the most new construction, most developers that are working, they're building there.
Got it. So Lawrence, are you doing pure ground up development? Is that your game?
I, honestly, Tom, I do everything. So I work with developers. Oh, go ahead.
Sorry, like the context of my question is, I like Pilsen. It's great. I can't find inventory there. So like, are you finding lots, and are these lots you have sat on? Because, that all sounds great, but as an investor, I'm scratching my head saying, I can't find anything there.
Well, Tom, that's a whole nother problem we're getting right now. So just before COVID hit, I remember last year, 2020, it must have been January, February. So the spring market was just starting, but it was before COVID hit. There was a period where I remember thinking, wow, the demand is so strong and the inventory is so light. Then, of course, COVID came and there wasn't that much inventory, but the demand fell off. So we kind of had that equilibrium. And now we're back with this demand being stronger than the inventory. So we're in a stage where it's not easy to find good buildings anywhere in the city, let alone Pilsen. You're 100% right. So what I'm doing, I would say over half the buildings that I've closed the last few years, I'm typically matching buyers and sellers before they even hit the market. And if COVID hadn't happened, it would probably be about 95% of them. I mean, that's the one value add, I guess. There's a lot of brokers in Chicago, but really what you want is you want to have the contacts to get the inventory before it hits the market. And the best thing that I can do is get a investor and get a developer and get them to agree on a price that works for everybody. I'm a big believer in life is not win-lose, whether it's real estate or whether it's life. You always want to be looking for, win-win scenarios where everybody's happy. And a lot of developers will pre-sell buildings or pre-sell rehab several months in advance because that way time is money. So if you can save a few months from finishing a building, marketing a building, finding a buyer, then his loan might take 6 weeks. If you can cut all that down, so you're literally having your inspection and appraisal when the building's 97% finished or something, and then literally closing the following week, it can be a win-win for everybody. So that's what I've been doing, Tom, is just trying to not letting too many things hit the market.
Got it. So you're partnering up with the actual developer and saying, hey, I will go find you someone that'll cut your lead time by X. Like I more than pay for myself. And I have this buyer pool that has proven to buy, and we're not going through back and forth of nickel and diamond.
Exactly. Yeah. And it's a win-win for everybody because the buyer, like I've bought a building myself in a bidding war and I just closed my eyes and I overpaid, but I'm a long-term investor, long-term thinker. So I'm thinking, I overpaid by $15,000 on a $900,000 building. That's a blip in the long-term scheme of things. So I don't mind doing that. But when I'm on the brokerage side of it, people are so funny. You're negotiating $1 million building, but then you get to the final stage where a lot of people's ego, they'll walk away from a deal over literally a couple of $100 because we all understand, $1,000 is, a weekend trip to Mexico, or $200 is a really nice steak dinner for you and your girlfriend. Like we know that, but when we're dealing with these huge numbers, 800,000, 1.1 million, our brains can't really comprehend these amounts. So it's so funny how my job is trying to just get people to see the big picture and think long term, because if you're trying to make a quick buck, real estate it's the way to get generational wealth, kind of like what we started with. So the little trivia for you guys: the first multimillionaire was John Astor. His grandson, John Astor III, was the wealthiest casualty that drowned on the Titanic, and that's so that kind of goes to show that it's generational wealth you're creating with real estate. It's very you got to think long term and let time be your ally, and you're going to do very well. So, but too many people, when they're on the buyer side, if I'm going to give advice to people looking to buy, is don't get too caught up in small things and walk away from good deals, especially in an environment that we're in now, which is it's tough to find good buys.
Yep. So let's pull that thread a little. Let's say, I'm 26 years old. I have $100K to work with. I can't go buy that $1 million ground up development that you're talking about. Like, yes. What is some advice if someone came to you, and I know you'd say, well, sorry, I can't help you with something in Pilsen, but where would you take that person?
Great question. Well, okay, so Pilsen goes east-west. So East Pilsen is insanely expensive, and the returns are not that good now because I think the prices are too high for the rents.
And according to brokers, West Pilsen goes to Berwyn, but continue.
Exactly. That's the thing. West Pilsen, in quotation marks, just keeps going west. Exactly. You have to keep going. So I remember, 2-3 years ago, people were terrified of going past Western. And then a year later, they were like, okay, I'll go to California. And now they're like, I'm going way past California. I'm selling a few buildings myself, past California. So unfortunately, if you're young, I would say in general, most young people have a bit more risk tolerance. I'm 42 now and I have a family, so and a young boy. I probably don't, it's ironic because I live in the South Loop, and the crime in the South Loop is pretty bad, actually. But anyway, that's another conversation. But you have a bit more risk tolerance when you're young, so you really want to stretch the areas where you live, and you're going to make the big money if you're on the border between where the good area and the bad area meeting. So in Pilsen, if you have 100,000, that's actually a huge budget. For people with less than that, even if your budget's 10,000, 20,000, you're looking at an FHA loan, and they just raise the FHA limits for 3 and 4 units. So you can still, you can get an $800,000 building and just put down a few percent, which is fantastic. So I would definitely say go for those FHA loans. And again, back to what I just said is you've got to don't walk away from something that has good fundamentals, good bones. It works for an FHA loan, but the roof is only got a few years left. Well, you'll deal with the roof in a few years. Try to think big picture. So if you're an investor buying with 25% down, your budget's up to $1 million, you have options. If you're an FHA buyer and you have a shoestring budget and you're trying to buy with 20,000, 30,000, 100,000 is actually a huge budget, then the less money you have to put down, the more you're going to have to make some sacrifices in areas, in buildings that work for the loan. So the key is really the loans, but because they just raised the FHA loans a few months ago, that's opened up a lot of doors for people.
With the ground up, is the majority of the buyers FHA owner occupied? Is that who your buyers are?
No. So for ground up development, they tend to be the 3 units. Most of the 3 units are selling, 8. It's probably the median price is about $850 right now. So that's over FHA limits. So most of those, almost all of those, I would say, are investors putting 25% down. So if you want to just talk a little bit about new construction versus rehab. So we started this conversation off saying, how are we going to protect our purchasing power? We have to invest in real assets. And then we talked about comparing some of the real assets. Well, bonds can't keep up with inflation. Equities has a bit of a limited upside, doesn't have the tax benefits. So once you got to, okay, I want to invest in real estate, you have all these different options. So investing in condos, I rent out my old condo, and it actually loses me a few $100s after I've paid the assessments and the taxes and all the other expenses, but I just keep it and forget about it. But it's very, very hard to make money in condos because you have the condo association fee. So investing in multi-units, my personal business model, what I recommend to my clients is you can either try to buy something and do a value add, like a fixer-upper type, or you can buy something that's either rehabbed or new. They're the two kind of broad choices. Because I work with these developers and I see their numbers, with material costs going up as much as they are, it's very, very, very hard to make money doing rehabs. Yes, you can put a bit of the sweat equity in, but for most people that have jobs, I think that they watch HGTV and they think they can do a bit of repainting and replace a stove and suddenly increase value. And it's not really that simple. So from my experience, even myself, I tend to let the professionals, let the developers do that. And I'm buying things that I want cash flow. If you're getting cash flow, but every month you have to be doing these big repairs, you're not really making the money. I'm all about the cash flow from property. So that leaves you with 2 choices. One is a rehab and one is new construction. So if you're that FHA buyer that we were talking about, Tom, you're kind of forced to go for the rehab because you're not going to get a loan for an owner occupant on new construction. And I always, up until a few years ago, I never appreciated new construction for what it was. I was always saying, if you have 2 buildings and one is a full gut rehab, meaning the plumbing, the electric, the roof, the mechanicals, everything is new, and then you have a new construction building, I would compare the two and I'd say, well, the big difference for those from a numbers guy, I'm a numbers guy. So the big difference for me is your tax tends to be higher on new construction than it is for a rehab. So because of that, I would always lean towards rehabs. But what I didn't understand is new construction. There's a few things just about new construction I've really come to appreciate in the last few years. And the first, I think, is when you have a beautiful rehab unit and you have a tenant leaving and you have your tenant turnover, it's a lot harder. And this doesn't really make much sense to me, but it's from what I'm seeing. It's a beautifully rehabbed unit and then new construction unit. For me, they're pretty similar. They're both lovely. They're both modern. They're both updated. They both have quartz counters, stainless steel appliances, in-unit laundry, wood floors, everything. It doesn't matter for the tenants. There's something about new construction. It's so much easier to get tenants. You have so much less vacancy, and they have they tend to, because they were recently built, the floor plans tends to make more sense. The square footage is more usable. These are all things that I didn't really come to appreciate up until the last few years. So I think when you factor in the less vacancy, when you factor in most of them give a builder's warranty, sometimes they even give a second year, third party warranty. When you factor all that stuff in, I've really come to appreciate for investors, new construction buildings over rehabs.
Yeah. Go ahead, Mark.
Where else around the city are you seeing this opportunity coming up, or where do you think some of the next opportunities for that type of development can be, assuming the market continues along the path it is right now?
Well, so for new construction, I have a lot of developers ask me this, and they say, well, if I can buy a lot, somewhere in Garfield Park for $20,000, East Garfield Park, or the same lot in Bronzeville is going to cost me $160,000, $170,000, shouldn't I be building where I can get the lots for almost nothing? But the cost to build is the same wherever you build it. So for new construction, I think it makes much more sense for them if they're putting in $500,000-$600,000 construction, just material costs and labor costs, to do that in the better areas. Whereas for the rehabs, I think the rehabs make a lot more sense in, like you said, Mark, in these areas you're trying to find. So we'll use Pilsen as an example, but I'll talk about a few other areas. So Pilsen, you're going to be doing new construction to the East Pilsen, and then West Pilsen, you're going to be doing more of the speculative rehab. But if you can do it this way and you can wait it out, again, talking about time being your ally with real estate, a lot of the developers that I know, the most successful ones, they're buying properties with tenants in, and they're leaving it, and they're doing the bare minimum for maybe a year or two. And during that year or two, things are spreading. So for instance, in our Pilsen example, things are spreading west as the price of the East get too expensive. The value is increasing, the rents are increasing, there's development going on around it. And then by the time they do the development, they put the money in, they've already created some equity. So if on the north side, East Humboldt Park is a great area to watch. 𝗲𝗄𝗂 is, again, Logan Square is very well known. Just west of Logan Square is 𝗲𝗄𝗂, kind of like as everything's spreading west. So 𝗲𝗄𝗂 is a place to watch. There's a lot of developments that, like the north side, that are doing things there into Avondale. And then on the south side, I really like, so I don't know how familiar you guys are with the south side, but I run a lot I live in the South Loop. So last weekend, I ran all the way past the end of the lakefront. And it's beautiful down there, all the beautiful historic buildings. And the south side of the city is I think it's a diamond in the rough. I think we're going to see, that's going to be the place to watch for me for the next few years. I think there's a lot of tax incentives for developers there. And I think that just the sheer amount of builders that are putting in huge amounts of money, building all these new construction developments, it's changing those areas, block by block.
How far south? I don't know how far you run.
So I ran to about 90th Street. So I did a long run this weekend. But typically developers, I think most developers that I know, they go to about 70th Street. They try and stay a little north, like 70th, 72nd. That's kind of where they're looking. So from there all the way to the South Loop, that's kind of the area where most people are developing.
So is that like the south end of Jackson Park, or am I wrong?
Yes, kind of like the middle of Jackson Park. Yeah, right around there.
Got it.
Yeah. And it's really interesting. If you drive around, so it's tough. So a lot of people are investing from out of state, or they live in the suburbs. They really don't know the city very well. But even when you write an offer in Chicago, you have 5 business days to cancel for no reason. So if you write an offer and you get it accepted, it's a good idea, especially if it's a building in an area you're not too familiar with, is you can learn a lot just from spending an hour just driving around. So for instance, when I was first looking at Bronzeville for my clients, I wasn't that familiar with it, a few years back. And just driving around, you'll see all these dumpster trucks from people doing rehabs. You'll see plans for new construction on vacant lots. You'll just see the areas a year or two before you're really seeing the price changing. So that's just in terms of market research. If you have access and you live in the Chicagoland area, that's a really good exercise to see. You can learn a lot just from driving around an area and just seeing what's coming. Because most developments are a year out.
Yeah. The other thing too, not to plug Cityscape too much here, but we've had them on recently, and where permits being pulled, right? It doesn't mean follow the masses because everyone's right, but like, man, if you got a ton of permits being pulled in an area, it's a sign, right? Like, 100%. All ships rise.
Exactly. Yeah. And I mean, listen, there's two buildings I just closed on 47th and Michigan, and the same developer's doing two more that we're under contract for. That block was pretty much desolate. And now he's going to have a row of four brand new construction, 3-unit buildings with all those tenants have good income, good credit. That alone has made that little pocket better, just one developer. And so what you said is perfect. Look at the permits, look at these people with deep pockets that are putting money and they're investing in these areas. And that alone is going to make the areas much better.
Yep.
I had a guy call me the other day for property management for 4720 South Wabash. And we actually bought that as 3 defunct condos down to the studs and we rehabbed it. And ultimately sold it, but he just said it got appraised out for 5. He bought it for 386 and thought he got a steal. Listen, I sold it for like 350 and I thought I got a steal, and he got appraised for 5.5 or something like that. So it's just kind of crazy.
Nearly doubled, yeah.
And there's a lot of land down there. Like I've always been a big fan of Washington Park or the Grand Cross or the Crossing, whatever that's Grand Avenue there at 47th in Michigan. Like I love that area. There's so many vacant lots too for that type of opportunity. And think about the expressway and the transportation's right there too.
I think that's sorry, Tom, real quick before Mark, that's 100% right. So all those vacant lots, there's a lot less vacant lots than there were 2-3 years ago because they're getting developed. But if you what you said is perfect. When you're looking at areas to invest, you really want to think about the infrastructure. And one of the reasons that Pilsen's so great is because you're right next to a couple of expressways, and it's the same. Lakeshore Drive is just so. People want to be close to the lake because the lake's beautiful, and then having Lakeshore Drive close to there, it just makes transportation so much easier. So that's definitely something to look for. If there's a pocket that might get developed, but it's not really near anything and it's not very convenient for tenants, it's probably not the best place to invest. So I think that's a very important caveat.
Yep. So with these lots, like let's use Hermosa for example, or even like what we're talking about on 47th here. Like, these things are not going to come out at $800K. Right. Like it's not like Pilsen where you're going to get that ARV on the back end. I guess like how are you, let's say it's Hermosa and you're buying a lot for, I don't know, 50K, 100K, depending on where you're at. And it's costing you 600 to build. Like that new construction 3 units not going for 900 yet or $1 million. Like
exactly.
Are these guys sitting on this for like 2 years and just waiting and like banking on the market? Like how are they making the numbers work? Because we see them happening. It is happening and someone's doing it. But like, great question. I can't follow the math.
Well, so one of my biggest developers I work with a lot, he's actually partnered with somebody who has thousands of lots in the city. And I don't know how he got them, but they worked out a partnership where he would give the developer the lot and the developer uses that as kind of collateral for maybe a hard money loan or development loan or something. And then on the back end, when they sell it, they're partners. So that's one way. So I have no idea how this guy is a very, very wealthy guy, how he has, several thousand lots, not just in Chicago. He has lots in Dallas. He has lots in Florida. I mean, the guy has lots all over the country. But that's one way to do it. But I think you're wrong, Tom. I would say that people aren't building new construction in Hermosa, for example, because the numbers aren't there. But let's use this example, 47th in Michigan. He bought those lots. As soon as he closed on them, he built 2 new construction buildings. He sold them in the high 700s, I think 780. And then straight away, he bought the 2 lots next door and he's building on those right now and they're already pre-sold. So that's an example of someone that's buying lots and building on them and the numbers work for him. But I love talking to these developers because I look at their margins and I mean, I get friends that are doctors or they have nothing to do with finance, nothing to do with real estate. And they'll send me pictures like, have you seen the price of 2x4s? Have you seen the price of lumber? Like the material costs are going up so much. The margins for these builders are so tight, which is remarkable. They can still make money. And I think that's another reason why I'm so optimistic for the price of real estate, for the investment aspect of real estate is if you own a building and the replacement cost, if someone burns it down, you have to rebuild it. Just the pure materials is going up so much, how are the prices not going to go up? And then if the price go up, how are the rents not going to go up? Because the builders have to make money, that the landlords have to make money. So I think it all works in lockstep with each other. But I think with the new construction, back to kind of our earlier what we were talking about, it's going to be in the more up and coming areas. It's not worth doing the new construction because the numbers don't work. So in that case, developers are likely sitting on lots. So if you look at a lot of lots that sell, a lot of the time the buyer would have owned them for 15, 20 years. So I don't know exactly if they were buying it as a speculative asset, for $5,000 many, many years ago, or, how they got it, whether it's a lot in the family or something. But a lot of them, they've owned it for a long time. over a decade, the areas change, and then they're selling it to a developer for, 100,000 or 150,000, and then the developer is doing the build. But in the more speculative areas, you're not getting the new construction; you're getting the rehabs.
Makes sense.
What is with all the price increases? What's kind of the cost per square foot to build new right now in Chicago?
Yeah, that's a great question, Mark. Honestly, I don't know off the top of my head, because if I'm selling, like I said, the beginning of the show, most of the new construction, the median price is, I'd say, 840, 850. So that means the range of new construction, I'm talking about, these are 3-unit buildings. They tend to be 3 units. Each unit is 3-bed, 2-bath. Sometimes they're 2-bed, 2-bath, same square footage, just a bit bigger bedrooms. Those buildings, if they're typically selling between 800,000 and 900,000, and the developer has to make money in the lot, so 150, I'd imagine that you're looking at about 500,000 for the build, plus you have the soft cost, plus you have the land, and then their margin is on top of that. So if those buildings are 3,600 square foot, I mean, it's probably maybe $150 a square foot. Does that sound about right? Yeah,
no, we're gonna have to. You and me are gonna have to get together after the show. You're gonna have to ask that to a couple of your buddies, because I'm curious on where that's at right now as well too. So,
Mark, I'll definitely get back to you. I'll talk to one of them as soon as we hang up. I'm due to call one of the builders, and I'll ask him for sure.
A couple of people asked me in the last couple of days, and I kind of BS my way through it. And I want to go back to him with some firm numbers. So that was my selfish interest in that question.
Well, let's say 150, and let's see how close I am.
All right. Yeah, post it on the Facebook page.
It is crazy though. I mean, those guys are like machines. Like Chris and I have looked at lots multiple times. Like he's building his house, he built my house, but from an investment standpoint, we don't compete well there. Like these guys just have the model figured out, and like we make a killing on these gut rehabs that are costing us, $300,000, $400,000, whatever the number is in rehab. But like ground up, man, it's just a whole new game that it's like a factory model, right? Like someone's got like the Model T down, and we don't.
Yeah, we've been trying for years too around on the kind of building these shell of industrial buildings as well too, out like just these smaller ones out in like the boondocks out here in Kane County, and we haven't been able to make the numbers work either. But it's just a different game.
Exactly. But I think that, I will say most developers I work with are one or the other. So they might dabble with rehabs, but their business model is new construction. They've been doing it for 10, 15 years. And every year they're just making subtle changes, making things slightly more efficient, just tweaking the floor plans, just trying to maximize that business model. And then the rehab guys, most rehab guys, they'll dabble every year or two. I'll try a new construction build. It'll take them way longer. And it's not really their forte. So what I'm seeing is there's a real specialization in what people do, and it tends to be one or the other.
Yeah. So going back to the question of cash flow, let's say you have a buyer and they're going to buy that new 3-unit, for $800K or whatever it is. How are you estimating the taxes, right? Because you have taxes on a lot that are nothing. Like I know you probably have comps in the area, but when does the city, we just got reassessed, right? So do they have a few years before the city really comes down on them? Like, do you have a little bit of a runway there? Like, how does that work?
That is such a great question. So I have an attorney who focuses just on tax stuff. And even he's often wrong. And he said there's no rhyme or reason why Chicago does what they do. The way I do it with a client or an investor is whenever I do a pro forma, the first year is always going to look fantastic. Because say you, Tom, you close today on a new construction building, even if you get appraised tomorrow and you get a letter saying that your tax has gone up to 10,000, it's going to be payable the following year. Yep. It's always paid in arrears. So you're always going to have 1 year of very, very low taxes and great returns on new construction. But sometimes people get lucky and they get 2 or 3 years. So it's typically once it closed, if the system we're dealing with a very inefficient bureaucracy in Chicago, as I'm sure you guys both know. But if the system was efficient, as soon as you close, you'd get it would go out, within a week or two straight from you're going to have a new price in the system, and then your tax would be based on that. But I've had buildings that one of my friends just sold a building he bought 4 years ago, and it was never assessed much higher than when he bought it. He got super lucky. So you do have those inefficiencies. But on a pro forma, the way I always do it is I assume that you close today, tomorrow you get taxed, so that'll be payable in year 2. So on the pro forma, year 1 is going to have really cheap tax, and you're going to have market rents. And then year 2 is going to have, I always run the same market rents, assuming there's no increase. So that's kind of you're running conservative numbers because I'm sure the rents will be a lot higher in a year than they are today. And then your tax is going to go up too. So on the north side, another reason that I don't love north side new construction is, it's 2 to 3% of a building. So an $800,000 building can be a $20,000 tax bill. It's outrageous. But you're seeing one reason I really like down by University of Chicago, Kenwood, is that you're seeing new construction buildings selling in the 850, kind of 800, 850 range. And they're getting reassessed at 6,000, 7,000. So they're getting reassessed at less than 1% of what they closed at, which for me is really, really cheap for new construction. So I don't know if there's some formula that my tax attorney doesn't know about, or if there's no rhyme or reason, but you just always get a huge tax break investing in the south side of the city.
Yeah, no, it makes sense. Even just in I'm almost strictly on the north side now, but for my time on the south side, like it's night and day. Like it's so, it just changes the numbers so drastically.
And what's really interesting from an investor's standpoint is when you have like a friend of mine bought those two side-by-side buildings on 47th and Michigan, for example, and we weren't sure what the rents were. We were there was nothing really like his buildings in that pocket. And so we were kind of guessing, okay, we'll list it for this and we'll see what we get. And then when you see the kind of tenants you're getting these tenants that are making 10, 12,000 a month, their credits in the high 6, low 7s. These are good tenants. Then you appreciate, okay, this area, then for the next time the builder can buy a lot for this much because his budget and he can still make money. So a lot of the last 5 years, I've been setting rental and sales comps in different areas of the city for 5 years, and a lot of time people come to me and they say, well, how can you tell this is a $2,200 a month rental? And I say, I can't because there's no comps I can send you, but I just know I can rent it for that much. And sure enough, I do. So it's definitely been a bit of an uphill struggle trying to talk to people that, of course, people that don't know me, it looks like I'm just plucking numbers out of my ass when I'm talking about this stuff, but I've been setting comps for a long time, and it's been really tough because a lot of these areas that I'm working in, I am the one, and then after me, there is comps, but initially someone has to go in these areas and set comps. So I'll give you a great example. I bought a building 4 years ago at 1600 West 𝗬𝗓𝗏. And when I bought it, it was a $700,000 4-unit rehab building. And when I got the appraiser came out, he appraised it at $520,000, professional appraiser. And I said, well, you're way off. I start talking to him. He's an older guy and he's very argumentative. And he starts talking about, Englewood in the south side. And I was like, well, what is Englewood? It's 5 miles away. At the time, it's the worst crime rate in Chicago. Why are you talking about Englewood when I'm in East Pilsen here? And he was just like, well, there's nothing like it. And so I went to Englewood. So it's incredibly hard to get a bad appraisal thrown out, but we managed to get it thrown out. Then I got another appraiser that came in. He appraised it at 770. So here you have the same building. You have two people, their job, I'm not an appraiser, I'm a broker and an investor. You have two people that their job is to appraise value, and they're appraising the same building a couple of weeks apart, one for 520, one for 770. That's $250,000 difference. So it's been incredibly frustrating dealing with just bad appraisers and people that just they can't really see value. And I think that's where the finance background comes in, is you're extrapolating backwards from what you can rent it for, looking at cap rates and things like that. But unfortunately, when it's less than 5 units, appraisers can't look at returns. They have to look at just pure sales comps. And unfortunately, when you're doing developments in these kind of areas, sales comps are looking backwards, what's sold. But value is today and looking forward. So it's been a constant battle, unfortunately. But I'm glad to say that I get a lot of calls from a lot of people, appraisers and things like that, asking me, well, what was this like that you sold, and how much is this worth and everything. And it's just been a constant process of learning. Like I don't pretend to know everything, but I learn, and I'm very open-minded, and I do my research. And I think that's the key with all of this stuff is have your game plan and then work backwards to achieve it.
You got the accent too. That helps.
There's a lot of pressure, Mark, but it does help.
All right. I'll take comps from you any day with that accent. All right. We'll move to our wrap-up round. You ready?
Always.
You have an impressive resume, top 1%, all that stuff. What do you do that others don't that makes you who you are? I reworded that.
I like that question a lot. I think it's a combination of what I just said is I'm always learning. So I definitely don't think I know everything. Too many people that are successful, they get this arrogance that they know everything. I can say that I love real estate and I love finance because I'm learning every day. And the other thing is relationships. Like I'm all about building relationships. If I have to, I've closed many deals where I haven't taken a penny, but I've strengthened a relationship and I'm working with them 5 years down the road. So I think that's the key is if you're a new agent and you really want to crack into the investment market, for instance, think long-term. Don't think about trying to get a sale on a big check. Think about building relationships, and that's going to feed you for a decade.
I have done that dozens of times in the last 20 years where it's like I made nothing for all that time I just put into it, but I said a whole bunch of other positive things in course for the rest of my life.
Exactly. And also it's good karma and good energy. You know, there's more to life than just money. Ultimately, I just want to be around good people, good energy, you know, hardworking people like me. And, you know, look out for each other. It's not just about the paychecks.
Yeah, absolutely. So we have a lot of people looking to buy their first property. What is the one piece of advice you would tell someone that is yet to buy their first property here in Chicago?
Great question, Tom. Think about what, like right now, I'm pretty sure we're going to keep seeing this inflation. We're going to keep seeing materials go up, values go up, rents going up. But you have to take all that out and you have to say, worst case scenario, there's another terrible wave, another COVID-3 or whatever, and the world's going to shut down. Can I sit on this and can I survive this bad period? So I think as long as you look at kind of these, obviously not worst case scenario, like, you know, nuclear war and there's blood on the streets type of thing, because then we're all screwed. But, you know, a pretty bad case scenario, can I wait it out? Because I think that's the key with real estate is you always have to go into when you buy a building, you have to have a plan. So if I buy a building and best case scenario, I buy it for 800,000 in 18 months, it's worth 1 million. That's best case scenario. I've got a million options. I can refinance it, pull money out, buy another building. I can sell it, you know, buy a boat, whatever I want to do. But look at the worst case scenario. Can I sit on this and can I hunker down and survive and make the payments and rent it out, at least cover all my expenses and survive, you know, for a year or two to wait out these bad periods? And I think as long as you can do that, then you're going to be okay. So try to look at the pro formas from a worst case scenario. And also you have to go into it. Listen, life changes. You might have to sell it 3 months after you buy it. You never know what's going to happen, but you have to go into every purchase thinking I'm going to hold this for a few years. Try to think long-term. That'll be a big thing.
Nice. What do you do for fun?
For fun, so I love pushing my body and sports. So I was a professional fighter in my early 30s. So I was an amateur boxer in my 20s.
Was that not on the resume? That should be the first thing I would say if I was you.
It's on LinkedIn. It's on LinkedIn. I read it. I'm like, man, this guy's everything I want to be.
Well, listen, I was trading on the trading floor. It's very stressful. So most people, you have to deal with the stress one way or another. A lot of people with drugs and alcohol. For me, I was boxing. So I won the Chicago Gold Belts 2006. And then I made a lot of money in my 20s. I got to 30 and I was like, you know, I got a lifetime to make money, but I got a very small window to do something, you know, professional fighter. So I had 10 professional MMA fights. I did a lot of jiu-jitsu competitions. I traveled the world. I had a great time. I was very financially responsible, but I did have a good time. So that was great. But Tom, remind me, I'm so sorry, I got sidetracked. Remind me the question. Oh, you said, what I do?
A whole other podcast. My mind is blown.
For fun. So for fun, I love pushing myself. So right now I'm 42. So the fighting is that's over. But I'm actually going at the end of the month. I'm going to Antarctica. I want to be the first jiu-jitsu black belt to have run a marathon on every continent. So I've got Antarctica as the last remaining marathon. So I'm doing a marathon there at the end of the month. So that's what I like doing for fun. I like hurting my body and freeing up my mind.
My gosh, this is almost unreal what you just said.
I'm trying to convince my wife to go to Florida for a weekend. Like I'm trying to can we just get out of the city for 3 nights?
I gotta say, that sounds very nice though. I love the sound. Listen, my wife's in the Philippines and her and I love, I love doing grand things and great things. I love making money so I can spend it, but I also love the small things in life. And honestly, weekend in Florida right now, look, I'm looking out of my window at the snow. Tom, that sounds pretty amazing.
Yeah, but you're going to Antarctica to run a marathon. This time, I feel like it doesn't even
sound real. Like that. That's the people are going to literally probably fact check that. Like that.
Well, listen, I got to be honest, guys. I'm absolutely terrified, and I don't like running in the cold, and I'm terrified. But I think that's what keeps life exciting. Is I'm a big believer in doing things, you know, facing your fears. So that's definitely a fear I'm facing. I'm not looking forward to it, but I know when I'm done, it's going to feel good.
Gosh, I feel like I've done nothing.
Yeah. All right. On that note, I guess what's it's a good book, podcast, or self-development activity besides running in Antarctica?
Yes, we all need to be way more self-developed after listening to this.
But I mean, listen, so when I was young, I used to read a lot. And then when I got into real estate, when I was fighting, I used to read a lot because I was so concerned about head trauma. I'm getting hit in the head, I'm losing brain cells. So I made a conscious effort to really take the time to read and educate myself. And then when I started in real estate, I was so busy trying to change career and rebuild myself that was one thing for a few years where I barely read at all. And then I realized that reading is definitely something that brings so much to my life. And so I really try and make a conscious effort. And it's so hard. But one of the reasons I love doing this, the podcasting, is my phone is in the other room. I'm being present with both of you for an hour, and it's no distractions. And I think anything we can do in this day and age in 2022, it's an attention economy. Everyone's competing for your attention. So anytime you can get away from that and get engrossed in a book and learn something, I'm always very happy. So it's something with a 1-year-old at home. It's something that I wish I could do more of, but I think reading is a great thing. And podcasts too. I get a lot of podcasts are like listening to a little audio book. So people listen to this conversation. It's like they listen to an hour audio book on real estate investing. They're going to get some tips. Even if they just get questions. So a lot of time if you're a new investor and you want to invest, you don't even know what questions to ask to start the process. So hopefully one thing that they can get from this conversation, if they're newer, is, okay, now I've got some questions. And the more you learn about a subject, the more, for me personally anyway, the more questions I have about it. And the more, because until you know about a subject, you don't even know which questions to ask. So I think podcasts are great. I think one thing, there's a lot of negatives to technology, but one amazing thing is, I was giving advice to a friend of mine who was out of shape. And he said, it's 2022. I want to get in good shape. What do I do? I said, buddy, you live on Clark Street. You're right by the lake. Put in a good podcast and go power walk for an hour. That's all you got to do. Start small, but use what you have. So we have so much great information out there. It's just a case of getting to it. And I think kudos to both of you guys. I think I get personally so much out of podcasts. So it's always a real honor and pleasure to come on a podcast and try and share things that I know about a subject that I'm pretty familiar with. And I think the more we can do that, it just makes the world a better place.
Nice. Besides yourself, name one person in your local network you'd highly recommend to other investors as a quality resource.
Well, I think that the owner of my real estate company, his name is 𝗤𝘃𝗲𝗀𝗀. He is my real estate mentor. He's just a fantastic resource. He's also an attorney. So if anyone's looking to get started in the real estate business, he would definitely be someone that I would recommend to talk to about being a mentor. And I think in terms of real estate investing, Jake and Mike, they're partners. We do a lot of business together. They introduced me to you guys. They are awesome people. They really know what they're doing, and they're just nice guys and good energy, and they're honest, and they're great peers to work with. So that there would be two off the top of my head.
Awesome. No, we will link to all of them. I think we have Jake and Mike scheduled to come on in a bit.
Oh, awesome.
Mike may be up your alley. He seems like a guy who would do some MMA or run in Antarctica.
Mike is so funny. If you look at his email signature, he's got this. I remember when he first emailed me, because I knew Jake from a few deals, and then his, my partner Mike, and I see his face. He's got this good-looking guy wearing a suit, and he's kind of got the Zoolander expression. I'm like, this fucking male model. And then I talked to him. He's like, yeah, I did a bit of fitness modeling, and I'm like, oh, you fuck, I knew it. He is such a great guy, because he doesn't. That guy is always sending me the most ridiculous, hilarious, funny memes. Doesn't take himself serious. But he's a very smart guy as his MBA. He's great. So I really like those two guys. They're both very professional, but they don't take themselves too seriously. So they are really, really great guys.
That's awesome. Lawrence, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Honestly, Tom, so if anyone's looking to get started on the investment side of real estate, my name, Lawrence Dunning, on my LinkedIn, reach out. I'd love to help you. It's not easy to do. So I would recommend you try and do as much, research on your own as you can. And then, and the other thing would be, I have a podcast I just started, Enter the Lionheart. And the idea is just being your best self. So I just have inspirational people on, whether it's entrepreneurs, athletes, business coaches, just interesting people that have traveled the world and done cool things. I think sharing stories and getting inspiration is something that I'm very passionate about. And just because I get so much out of podcasts, I wanted to give back. And I'm very blessed to have a very wide network of people, of whether it's people that I know pretty well, or whether it's friends of friends and acquaintances of friends. So that's kind of my new passion project, which I'm trying to start, which I started a year ago. And it's just trying to put good energy out in the world. And also, sharing wisdom, sharing knowledge. I think we're so lucky to live in an age where I can have a conversation with one of my dear friends and one of my mentors. He lives in Perth, Australia, and we can jump on a Zoom call and we can talk for an hour. We can do a podcast. So there's a lot of negatives to technology, but there's a lot of positives too. And I think we should really appreciate the positives.
Good stuff. All right, Mark, we haven't had a question in a while. This one's gonna be, you're not gonna know. This is gonna be multiple choice. Let's see how good you are at your random guessing here. All right, and then Lawrence, I'll give you a shot too. So, as a sign of sympathy and kindness for Chicago, after the Great Chicago Fire, London-based A.H. Burgess suggested that England present this to Chicago. And it was A, Chicago's first library, B, redevelopment plan, which later became the 1909 plan of Chicago, C, initial funding for a hotel building, which became the Palmer House, or D, Chicago's first brick bungalow.
The Palmer House funding.
Lawrence, you want to go with the guess?
I was actually going to go with that too, but I got to do something else now. To be different. You know what? I'm English and I have zero clues. I'm gonna go with Mark on this one. The Palmer House. It just sounds like it's right.
No, I'm sorry. I put you guys down a rabbit hole by making that one too specific. It was the Chicago's first library. Came from
it's the library. Wow, good. Well,
yeah,
good for my people.
Which one? Does it still exist?
Trying to spread literacy.
The internet didn't tell me which one. I will look it up for you though. It was opened in January 1st, 1872.
Wow.
Really?
Wow, that's awesome.
They could have donated some financing. They just donated a library.
Yeah, I guess like if my house just burned down, a couple books wouldn't make me feel that much better.
Yeah, for sure. All right, Lawrence,
that's how important reading is, guys.
Yeah, Lawrence, man, it's been great having you on here. This is a very entertaining hour, Tom. Thanks as always. Listeners, please, like we talked about at the beginning of the show, any way you can help us is to leave us reviews or find us other guests that you would be interested in listening to. So obviously we talked about here, Lawrence came from another past podcast member and someone that's part of the Chicago kind of real estate network. If you know somebody, that'd be a great guest. We'd love to have him on, and then leave us a review. Lawrence, thank you very much. Tom, thank you as always. And we'll talk to you soon.
Thank you for having me, guys. Really appreciate it.
Thanks all.